What's causing inflation to be relatively persistent in this economy? That's what I'm going to cover in this video. So guys, as you guys smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now this whole story about inflation is very relevant for investors because we're trying to figure out just how high the Federal Reserve is going to raise rates. And this past week we didn't really get a good indication of rate increases slowing down. And what I mean by that is Jerome Powell came out and said that the Federal Reserve is prepared to speed up the rate at which they're going to be increasing interest rates in the next couple of meetings. So that's really scary because we thought that they were going the other way and they were going to start slowing down the pace of interest rate increases. And just diving into the article a little bit, you can see that Federal Reserve Chair Jerome Powell did say that the Federal Reserve would consider raising interest rates by a larger half percentage point this month and was likely to lift rates higher than previously expected this year to cool the economy that has shown surprising strength. And so the latest economic data has come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. That's what Jerome Powell said. But guys, keep in mind that this is what he's been saying for a long time. He's going to be following the data, and as should we. But at the end of the day, when it comes to investing, I generally just look for great opportunities in the environment. However, I do like to pay attention because this could sort of like let me know if there's opportunities for value investors as they continue to raise rates. And of course, understanding the economic environment that you're in will of course allow you to better allocate capital. And so he made a comment about a stronger than expected economic environment. What exactly is he talking about? Well, when you look at the January inflation data, as of right now, the Feb inflation number is not out yet. The annual inflation rate in the US slowed to only 6.4% from 6.5% in December, which was much lower than what the market was forecasting at 6.2%. So, the challenge here is that the persistent level of the inflation rate is creating challenges for policymakers because at the end of the day, it's still 3 times higher than their target of the inflation rate being around 2%. And so, of course, they're going to have to get more aggressive. So this means that the stock market is likely going to continue to fall further, which it did do this week. And so the question is, what exactly is causing inflation to be as persistent as it has been? Well, notice that the non-farm payrolls actually surged in January. The economy added 517,000 jobs. Now, the February job report is out. I'm going to cover that in a separate video, but this actually shocked economists who are anticipating hiring to slow down, while the unemployment rate actually declined to a 34-year low. So needless to say, the economy is hot. Now, I'll cover more of that economic data in a subsequent video, but what I wanted to talk about was in the monthly call that the Patreons and I had this month, I walked through the latest monetary policy report that was released by the Federal Reserve System just a couple of days ago. I think it was a week ago that this was released. And I highly encourage you guys to read this report because there's a lot of interesting data and you kind of see what the Federal Reserve is seeing. And so, one of the reasons why we've had such persistent levels of inflation is because we've seen a surge in earnings across all groups, which has pushed up inflation. And this is not anything that you guys already don't know. But the question is, why is this happening? Well, part of the reason, it's something that I covered a while ago, maybe like 2 years ago on this channel, is that a big piece of this is just accelerated retirements. Notice the red line here is the expected level of retirements, and then notice the blue line, it actually surged post-COVID and it doesn't look like it's slowing down. So there's a lot more people leaving the workforce than we anticipated for. And so the question is, why are all those people leaving the workforce? Well, I got 3 reasons for you. So first, there's little sign of a reduction in excess retirements, meaning that, there's a little sign that people are going to come back into the workforce. And so instead, what's happening is workers are still retiring at higher rates than before the pandemic. And, I think there's 3 major reasons why this is happening. The first is health concerns. COVID actually impacts older people more. And so there's just an elevated risk. So why be at work if it's going to potentially risk your life? I know a lot of people who retired early as a result of this. The second one is age-related displacements. If you lost your job during the COVID pandemic, or you've recently lost your job as there's been layoffs, it's harder to find employment due to age-related limitations. And so you probably will just say, okay, you know what, I didn't really want to retire 3 or 4 years early, but you know what, I'll just stay retired at this point. And I think the major reason, at least for a certain part of the population, is the fact that post-COVID, we've had major increases in wealth. And so increases in the stock market and real estate prices have caused, people to decide, I'm sitting on like $1 million or $2 million of excess capital on my house. Why don't I sell it, relocate somewhere else, and then just retire? And so I think that this has been a big reason why a lot of people have been retiring. I think excess retirements have been the largest among college educated workers, who were probably the people who were sitting on most of the real estate prior to the COVID pandemic anyways. And like, if you're already sitting on real estate and it's largely paid off anyways, which I think like 20 or 30% of homes in the US are completely paid off. You guys let me know in the comments what the actual data is. If you're sitting on all of that and then the equity in your home grows substantially, why wouldn't you just sell that house, downsize? Your kids are already out of the house, you're nearing retirement age, and you just retire 10 years early, travel the world. It makes a lot of sense. If I was that age and I was sitting on that much equity on my home at that time, I'd probably do the same thing. So of course, you guys know that this probably has caused a havoc to the jobs market, because you notice that there seems to be a widening gap between the number of available jobs, which are the ones here in gray, and the number of available workers. And so of course, the job market is a demand and supply market. So if you have more demand for people than you have supply of people, it's going to push salaries higher. And so one of the reasons why the Fed is continuing to increase rates is because they're trying to bring this number down. They want to get the number of available jobs lower so that there's less wage pressure. And speaking of the wage pressure, you can see it right here. The imbalance has caused wages to grow. And although wage growth has slowed in the second half of 2022, but it still remains elevated. Like, it's still, I would say, 6% higher than last year. So that really is a big reason why we're continuing to have persistent levels of inflation. They really got to get this down. Now, you can see some signs of cracks a little bit in the economy. Despite the increases in wages, it looks like real incomes have actually fallen, and households have had to rely on savings that were accumulated during the pandemic. And as such, the personal savings rate has actually plunged to much lower than it was pre-pandemic. Notice people, right before the pandemic, they were saving around 8% of their income, and now they're under 4%. I guess they just got over 4%, but less than, or just about half. And for a lot of 2022, it was well below half. So we'll see how this plays out. Does this mean that people are using that savings that they did have previously to pay for regular home expenses? Does it mean that credit card balances might start increasing? Is that an indication that the consumer is tapped out? A lot of people are saying that they have the answers. They really don't. It's really still a wait and see type period, but it is heading in that direction. So we'll see how this plays out. But notice that the savings rate has started to pick up a little bit as 2023 begins. So is this a sustainable growth rate back up to that, pre-pandemic rate of 8%, or is this just a little bit of a blip before it goes back down? We'll see how this plays out. And as you can see, I spoke about the credit card debt, and it's because I've seen this chart before. So notice credit card debt has expanded quickly, and for now the delinquent balances do remain low, but this is a warning sign. As people's credit card balances increase materially and delinquency start picking up, that's a really strong sign that we're headed into the wrong direction. But from an inflationary perspective, it's actually the right direction because the economy is slowing down. And so this is something that I'm going to continue to watch. Now, this is an interesting chart that they do provide in the report. The federal funds rate assessment, this is not their target amongst the federal open market committee participants, is around 5.25% for fiscal year 2023. I think what Jerome Powell is kind of saying is that, because there are more persistent levels of inflation, this might actually increase higher. And so, do we get to the 5.5 to the 5.75% range in 2023? That'll largely be outside of most of the participants' forecast right now. So, it could even be a surprise to them. At the end of the day, they're following the data, so we'll see how this plays out. But right now, they're essentially targeting 5.25%, but that could go up. And just a reminder, guys, right now the target is set between 4.5 and 4.75. And so a 50 basis point increase will only get us to that 5.25% assessment figure. We can potentially go even higher from there by another 50 to 100 basis points, depending on the stickiness of inflation. So, I would say just buckle up in this environment. We'll see how bad this could potentially get. Remember, guys, that the yield curve is actually inverted. So what that means is that the whole market is really expecting us to get into a recession. So that is a little bit scary, but it could potentially open open up opportunities for value investors. And so like I always say, have some dry powder on the side. It's never investment advice, of course, but that's exactly what I'm doing. And so I want to hear from you guys. I understand that we're going to probably have a 50 basis point increase with the next tightening cycle, but subsequent to that, where do we finish off 2023? Do we get as high as 6%? Do we go even higher? I want to know what you guys think, and so let me know in the comments below. And speaking about the economy, China's economy is actually starting to surge, and if you haven't seen that video, you can get to it right here.